The American dream is starting to feel more like a hostage negotiation. You save for a decade, you fight through bidding wars, you finally get the keys to your little patch of earth, and then the real bills arrive, the ones they never put in the brochure. Suddenly, that $300,000 house costs you an extra 50 grand a year in taxes, insurance, and fees they conveniently forgot to mention. It's a setup. We're going on a road trip to the 10 states where this dream is dying the fastest. Stick around and I'll show you exactly where the financial sinkholes are hiding so you don't fall in. This is your survival guide to the new housing market, where your biggest threat isn't your mortgage, it's everything else. But don't assume the danger is just coastal hurricanes or western wildfires. Wait until you see the quiet Midwestern state where your property tax bill can legally double in a single year. Or the mountain towns where insurance companies have just stopped answering the phone. Hit like if you're tired of being played, and subscribe so you don't get caught in the fine print. Let's hit the road. Number 10. Nebraska. You roll the windows down and the air smells like dirt and corn. Welcome to Nebraska. It's flat, it's quiet, and it feels like the kind of place where nothing bad ever happens. The houses look sturdy, the lawns are neat, and you can almost hear the promise of a simple, affordable life. Almost. Because under this calm surface is a financial grinder that's chewing up homeowners. The real tornado here isn't the one you see on the news. It's the property tax bill that lands in your mailbox. According to a 2025 analysis from WalletHub, Nebraska has one of the 10 highest effective property tax rates in the entire country. We're talking rates that can be double what you'd pay in states like Utah or West Virginia. On a modest $300,000 house, you could be looking at a bill of over $5,000 a year. That's an extra $400 a month just for the privilege of existing on your own land. Why? Because the state heavily relies on these taxes to fund schools, and for decades, those costs have only gone up. Then comes the insurance. Being in the heart of Tornado Alley used to be a manageable risk. But recent data from the insurance industry shows that after a string of severe hailstorms and tornadoes, premiums are climbing fast. Some Nebraska homeowners reported their insurance costs jumping by 20 to 30% in the last year alone. It's a quiet crisis. There's no mass exodus, no flashy headlines, just the slow, agonizing squeeze of non-negotiable bills. You buy here thinking you found a safe haven, a refuge from the chaos of the coasts. Instead, you've just traded a hurricane for a tax bill that hits with the same force year after year after year. For those of you living in the Midwest, are you seeing this same slow bleed from taxes and insurance? Drop your state and what you're paying in the comments. Number 9. Oregon. You push west, leaving the flatlands behind, and drive straight into a postcard. The trees are so dense they drink the sunlight. The air smells like pine and damp earth, and you're half expecting a woodland creature to offer you a mortgage. This is the Oregon dream, sold to you in a million Instagram posts. It's a promise of a life connected to nature, a progressive haven where you can escape the concrete jungle. You find a little house tucked away in the woods and think, this is it. This is peace. Then you try to get it insured. Good luck. According to reports from the Oregon Division of Financial Regulation, the state is in a slow-motion insurance crisis. After years of devastating wildfires, insurance companies are terrified. They're using new, aggressive risk scoring models that can label your beautiful forest home as uninsurable. Thousands of homeowners, particularly in areas near Ashland and the Cascade foothills, have seen their premiums double or triple. Many more have received the dreaded non-renewal notice in the mail. Just gone. You're on your own. But even if you dodge the fires, you can't dodge the state tax collector. Oregon hits you with one of the highest state income tax rates in the nation, topping out at 9.9%. Let that sink in. For every $100,000 you earn, the state of Oregon takes nearly $10,000 right off the top, and that's before the federal government gets its share. You're paying California-level taxes without the California-level salaries in many parts of the state. It's the paradise tax. You're paying for the view with your financial security, caught between the literal fire that could take your home and the financial one already burning through your bank account. Let me ask you this. For a place this beautiful, how much financial pain is too much? Is there a number where you'd just walk away? Number 8. Illinois. You cross the state line into Illinois and the landscape flattens into a grid of towns and farmland. The architecture feels solid, dependable, lots of brick. This is the heartland, the industrial Midwest. You see houses with neat front porches and think, this is where you build a life. But for a growing number of people, this is where you pack up a U-Haul and leave. They aren't running from fires or hurricanes, they're running from the tax man. Illinois is in a league of its own when it comes to property taxes. A 2025 study by the Tax Foundation consistently places it as one of the top 2 most punishing states in the country, right alongside New Jersey. The average effective rate is a staggering 2.3%. So that same $300,000 house that was getting expensive in Nebraska, here the bill could be $7,000 a year, or more. In some Chicago suburbs, it's not uncommon to see annual tax bills hitting $10,000, $15,000, even $20,000 for a standard family home. It's not a tax bill, it's a second mortgage you can never pay off. And the people have responded. According to recent census data and analysis from moving companies like United Van Lines, Illinois is a leader in one grim category: outbound migration. For years, more people have been leaving the state than moving in. It's a slow-motion demographic collapse. The state's financial troubles mean they have to keep the tax pressure high, which pushes more families out, which shrinks the tax base, which means they have to squeeze the remaining residents even harder. It is a death spiral. You're not just buying a home here, you're inheriting a share of a massive unfunded liability. The house might be affordable, the state is not. For anyone who's lived in or recently left Illinois, does this ring true? Are the taxes the real reason you see so many moving trucks heading out of state? Number 7. New Jersey. You merge onto the turnpike and everything gets compressed. The lanes are tight, the houses are packed together, and you can feel the gravitational pull of 2 massive cities, New York and Philadelphia, squeezing this state from either side. This is the definition of location, location, location. You're close to everything: the jobs, the culture, the coast. You find a nice colonial in a town with great schools and think you've made it. And you have. You've made it to the top of the list for the highest property taxes in the United States. It's not an exaggeration. It's a statistical fact. Year after year, the Tax Foundation confirms that New Jersey homeowners pay the most. The average property tax bill in the state, according to their 2025 data, is pushing $10,000. That's not for a mansion. That's the average. On a $400,000 home, your bill can easily top $800 a month. That's a car payment, a student loan payment. That's a separate phantom mortgage that never ever goes away. It just goes up. But you pay it for the good schools and the proximity to the shore, right? Well, that shore is getting closer. A recent analysis by Climate Central highlights that huge swaths of the Jersey Shore are facing chronic flooding risks. Thanks to rising sea levels and more intense storms, areas that used to flood once a decade are now seeing water in the streets multiple times a year. As a result, flood insurance, where you can get it, has become brutally expensive. FEMA's new rating methodology has caused premiums in some coastal counties to soar. So you're paying the highest taxes in the nation for the privilege of living in a home that could be declared a waterfront property after one bad storm. It's the ultimate financial trap. Here's a question for you. If your property tax bill was already $10,000 a year, how much would your flood insurance have to go up before you'd consider moving? 1,000? 5,000? At what point does the dream become a delusion? Number 6. Arizona. You head southwest, and the world outside your car transforms. The green of the Midwest gives way to a vast, cinematic landscape of red rocks and towering saguaro cacti under a sky so blue it hurts to look at. You drive through Phoenix, past endless rows of beautiful stucco homes with pristine gravel yards and shimmering pools. It feels clean, modern, affordable. You see why millions have flocked here. It's the promise of a perpetual vacation for half the price of California. Then you turn on the tap, and you start to wonder how long the vacation can last. The secret everyone in Arizona knows but hates to talk about is water. The state was built on a miracle of engineering that piped water from the Colorado River to turn a desert into a suburb. But according to the U.S. Bureau of Reclamation's 2025 forecasts, that river is running dangerously low after a 2-decade-long drought. The cuts are no longer theoretical. In some fast-growing areas, the state has already been forced to halt new housing construction because developers can't prove a 100-year water supply. Let that sink in. You can't build a new house because the water literally might not be there for your kids. Then there's the heat. It's not just uncomfortable, it's becoming a genuine threat to daily life. National Weather Service data shows cities like Phoenix are shattering heat records with dozens of days over 110 degrees Fahrenheit. Surviving here means running your air conditioner non-stop for 5 months. For many, the summer electricity bill now regularly tops $400 or $500. It's a sunshine tax you pay for the privilege of not getting heat stroke in your own living room. You're buying into a lifestyle that is fundamentally at war with its own environment, betting that technology will solve a problem that nature seems determined to win. So here is the question. Is it a smart move to buy a home in a place that is actively running out of water and becoming physically harder to live in? Or is the lure of affordability today worth the gamble on tomorrow? Number 5. Colorado. You leave the desert behind and start to climb. The air gets thin and crisp, and the horizon explodes into the jagged peaks of the Rocky Mountains. You drive into towns like Boulder and Golden, where the foothills serve as a backdrop for a life of hiking, skiing, and craft beer. This is the Colorado promise, a healthy, active lifestyle where your backyard is a national park. You find a home with a stunning view, pay the premium, and feel like you've bought a piece of heaven. And then you get the bill for living on the edge of paradise. The first punch comes from your insurance agent. After catastrophic events like the Marshall Fire, which wiped out over 1,000 homes in a single afternoon, the insurance market here is in a state of panic. According to the Colorado Division of Insurance, premiums in high-risk areas, the beautiful mountain and foothill communities, have skyrocketed. Homeowners are reporting increases of 50, 100, even 200%. Thousands are being dropped entirely, deemed too risky to insure at any price. Without insurance, you can't get a mortgage. Your beautiful million-dollar view home becomes an unmovable, unsellable asset. Then the second punch lands, the tax assessor. Following the repeal of a long-standing tax-limiting amendment, recent property reassessments across the state have been brutal. The Colorado Sun reported that in 2025, homeowners in many counties saw their property valuations jump by 30 to 50%. That's not a typo. Your home's value on paper soared, and so did your tax bill, with no corresponding increase in your income. It's a financial shockwave hitting hundreds of residents simultaneously. You're paying a fortune for the view, a fortune for the fire risk that comes with it, and now a fortune in taxes because that risky view is considered more valuable. We're halfway through this nightmare road trip. And if you think this is bad, wait until we get to the states where the financial threats aren't just looming, they've already swallowed entire communities. Number 4. Texas. You cross the border and the whole scale of the world changes. The sky gets bigger, the highways get wider, and the sense of ambition is everywhere. You drive through the suburbs of Dallas or Houston, and it's a sea of new construction. Gated communities, sprawling brick houses, brand new schools. This is the Texas model in action. Low regulation, endless growth, and the promise that you can get a bigger house for less money. And for a while, it feels true. You get a 4-bedroom house for the price of a shoebox in Denver. You pay no state income tax, you think you've cracked the code. Then the bills start showing up, and you realize the code was written to crack you. First, the property tax bill arrives. Since Texas has no state income tax, it funds everything, especially its top-tier school districts, through property taxes. And they are brutal. Consistently ranked in the top 5 highest in the nation by sources like the Tax Foundation, the average effective rate can be nearly double the national average. On that $400,000 dream home, you could be looking at an annual bill of $8,000, $9,000, $10,000. It's a relentless, ever-escalating cost that can, and does, force people on fixed incomes out of homes they've owned for decades. Then the weather tries to kill you. After the catastrophic grid failure during the 2021 winter storm, Texans learned a hard lesson. The state's independent power grid, ERCOT, is a gamble. Every summer, as temperatures hit triple digits for weeks on end, the grid teeters on the edge of collapse, begging residents to turn up their thermostats to avoid blackouts. Your reward for this? Some of the highest electricity bills in the country. And down on the Gulf Coast, the insurance situation is a slow-motion disaster. After every major hurricane, premiums jump, and deductibles, often set as a percentage of your home's value, can mean you have to pay the first $20,000 of damage out of pocket. Is the no income tax advantage just the country's most successful marketing scam? Let me know what you think in the comments. Number 3, Louisiana. You head east from Texas, and the air gets thick, heavy with humidity and history. The landscape softens into bayous and wetlands, and the culture hits you like a spice blend. The music, the food, the architecture, it's intoxicating. You drive through a town and see a beautiful historic shotgun house for sale at a price that seems like a typo. $180,000? You could pay cash for that with the equity from your place in Austin. You think, I could live here. I could really live here. Then you make a phone call to an insurance agent, and the dream dies. Welcome to the state with the most broken home insurance market in America. After being battered by a series of catastrophic hurricanes, Laura, Delta, Zeta, Ida, the private insurance industry has simply given up on Louisiana. According to the Louisiana Department of Insurance, over 20 companies have pulled out of the state or gone insolvent in the last few years. The ones that remain are charging astronomical rates. A 2025 market analysis shows the average annual premium for home insurance has soared past $6,000 statewide and can easily top $10,000 in coastal parishes. That's over $800 a month. On a $180,000 house, your insurance bill is literally a second mortgage. For millions, the only option left is the state's insurer of last resort, Louisiana Citizens, whose rates are legally required to be even higher than the private market to avoid competing. It's a government-mandated punishment for living in your own state. You're not buying a home, you're buying a ticket to a financial casino where the house always wins, and the next hurricane can wipe you off the board. The house is cheap because the cost of protecting it has become completely, utterly unaffordable. So here's the hypothetical. If someone gave you a free house in Louisiana, but you had to pay the $10,000 annual insurance bill in cash, would you take it? Or would you just keep driving? Number 2, California. You drive north, hugging the Pacific Coast Highway. The cliffs drop into a churning blue ocean, the sun hangs in a perpetual golden hour haze, and you're surrounded by a sense of infinite possibility. This is the California dream, distilled and sold for $1 million a pop. It's the cultural center of the world, the engine of innovation, the place where fortunes are made. You find a home perched in the hills, overlooking the canyons or the coast, and you feel like you've reached the very pinnacle of American life. And then you discover it's uninsurable. This isn't a future problem, it's happening right now. Major insurers like State Farm and Allstate have publicly announced they are either pausing or severely restricting new homeowner policies, creating what insiders are calling insurance deserts across the state. The state's own Department of Insurance data from 2025 shows hundreds of thousands of non-renewal notices have gone out in the last 2 years, leaving homeowners stranded. Why? Because the risk of biblical-level wildfires has made insuring entire communities a money-losing proposition. Your only option becomes the FAIR Plan, the state-mandated insurer of last resort. It's a bare-bones, last-resort policy that can cost 2 to 3 times as much for a fraction of the coverage. It's a ghost policy, often not even covering liability or water damage from, say, the atmospheric rivers that now regularly cause massive flooding. So you're paying a fortune for fire protection, and you have to go out and find a separate policy for everything else. All of this on a house that already costs, on average, north of $800,000 according to the California Association of Realtors. You're not just buying a home, you're buying a zip code on a blacklist. You are paying a premium for a lifestyle that the financial system itself has declared a bad bet. When $1 million asset becomes impossible to protect, is it still an asset? Or is it just a liability with a nice view? Number 1. Florida. And here we are, the end of the road. This is the grand finale, the place where all the financial plagues we've seen across the country, soaring insurance, climate threats, and toxic affordability, all converge into a perfect storm. This isn't just the number 1 state on our list. This is the state that serves as a flashing red warning light for the entire American housing market. This is where the dream officially becomes a delusion. The Insurance Information Institute's latest data for 2025 shows the average Florida homeowner is now paying over $6,000 a year for insurance. That's $500 a month. That isn't for your mortgage payment. That isn't for your property taxes. That is the fee you pay to a company that is actively looking for a reason to leave the state, just for the chance they might help you after a hurricane turns your neighborhood into a lagoon. It is a complete and total market failure. Dozens of private insurers have already fled, leaving millions of homeowners with no choice but to run to the state-run insurer Citizens, which has ballooned into a financially unstable behemoth. It was designed as a last resort. Now it's the only resort. And if a monster storm hits and drains its reserves, every taxpayer in the state could be hit with a hurricane tax to bail it out. You're paying the highest premiums in the nation to be first in line for a potential statewide bailout. It is mathematically insane. The house is no longer the asset. The house is the liability. The house is the bait in a trap set by Mother Nature and runaway greed. So, is this still paradise, or has it become the most beautiful, sun-drenched financial trap in America? Let me know in the comments. So there you have it. The price on the listing is just the down payment on the pain. We drove through states being bled dry by taxes, scorched by uninsurable fires, and drowned by policies that have already collapsed. The real takeaway isn't just to avoid a hurricane, it's to read the fine print on your tax bill and your insurance policy, because that's where the real disaster is waiting. Did we miss a state you think is becoming unlivable? Drop your own warnings in the comments below. Subscribe so you don't get trapped in the next real estate nightmare.